Singaporean investors are obsessed with dividends. And I get it, it feels like free money. But what if I told you that the dividend you just received didn't actually make you richer? In fact, chasing that dividend could actually be the reason that your portfolio is underperforming. Today, I'm going to show you the math that proves that dividends are not profit. They are merely a forced withdrawal that you did not ask for. To understand why dividends are not free, we have to look at where the cash comes from. Imagine a company share costs $100. And inside the company, there is $5 of cash sitting in their bank account. That $5 belongs to the shareholders. It belongs to you. Now, the company pays a $5 dividend. They take that cash out of the company and put it into your hand. But here is what 90% of investors miss. Because that cash has left the building, the company is now worth less, and the stock price drops from $100 to $95. This isn't just my opinion. This happens every time a dividend is paid. The exchange literally adjusts the price downwards. This is the price chart of UOB. Zooming in, we see that on the ex-dividend date, the price of the stock falls, roughly equal to the amount of the dividend paid. So, before the dividend, you had a $100 stock, and after the dividend, you have a $95 stock and $5 in cash. Your total wealth? Still $100. You didn't make a single cent of profit. Once you understand that math, you realize what a dividend really is. It is just a forced withdrawal. When a company pays a dividend, they are forcing you to cash out part of your investment. Compare this to selling shares. If you own a growth stock that doesn't pay a dividend, you decide when to sell. You are in control. With dividends, the company decides for you. They force cash into your hand whether you need it or not. And this could trigger a tax event depending on where you live. But you might say, okay Sean, but I still like the cash. And I get it. In Singapore, we love our REITs and telcos. But here is where the hidden cost really gets you. When a company pays out all its profits as dividends, it has no more money left to grow its business. Look at a classic high-yield stock like StarHub or an old-school telco over the last 5 years. You collected great dividends. But the share price? It likely stayed flat or dropped. Now, compare that to a company like Google that pays zero or minimal dividends and reinvests everything. Because they reinvested their cash to build new products and grow their business, the share price kept going up. Would you rather have a consistent 5% check every year while your principal shrinks, or would you rather be rich? Now, don't get me wrong. I'm not saying never buy a dividend stock. If you're retired and need money to buy your chicken rice and your kopi every morning, dividends are amazing. They save you the hassle of having to sell your stocks every month. And there are great companies like our local banks, DBS or OCBC, that pay dividends and still grow earnings. But they are great investments because the business is growing, not because of the dividend. Do not confuse the two. So, if dividends should not be your main metric, what should be? You need to focus on total returns, that is dividends plus the price appreciation. If you want to see which ETFs I use to capture that total return without chasing high yields, I put a link to my ETF guide in the top comment below. Now, I know what I've said goes against everything your aunties and uncles have told you about dividend investing. It sounds controversial. But I didn't invent this math. This is called the Dividend Irrelevance Theory. And if you want to see the deep academic data that proves this, there's this one video by Ben Felix that explains it better than anyone else. Click right here to watch that video. It will change how you invest.